Tonight's story is not breaking news, it's breaking reality. The finance industry in 2026 is designed with one clear objective: to ensure the majority of people remain trapped in a cycle of debt, stress, and financial instability, while a select few at the top amass wealth. The industry's core model revolves around extraction, not by helping you build wealth, but by keeping you dependent on borrowing and exorbitant fees. As of 2026, household debt in the U.S. exceeds $18 trillion, with interest rates that have reached astronomical figures. Credit card APRs range from 22% to 28%, and payday loans come with effective interest rates soaring between 300% and 1,000%. These numbers aren't a coincidence, they're engineered. The system is structured to keep you borrowing and racking up penalties. Take a payday loan. You need $500 for an emergency, like a car repair. A lender offers the money, but at a staggering cost. Lenders charge $15 to $30 per $100 borrowed. 75% of payday industry revenue comes from repeat borrowers stuck in this cycle. What started as a $500 loan ends up costing $200 or more. This is a wealth transfer from the desperate to the lenders. Credit card companies use a similar tactic. Minimum payments are often so low they barely touch the principal. Interest just compounds. One missed payment can trigger a penalty APR of up to 29.99%. Suddenly, your credit score tanks, making everything more expensive. In 2026, it's worse. With regulatory rollbacks like the removal of overdraft fee caps in 2025, lenders have become even more aggressive. Apps like Buy Now, Pay Later appear interest-free, but late fees are crippling, rolling balances into high-interest cards. While household debt continues to rise, wages remain stagnant for most Americans. The pressure is becoming unbearable. The human cost is devastating. Families lose homes to foreclosure, and relationships break under the immense pressure of financial stress. Health takes a hit as anxiety levels soar. This isn't just bad luck, it's the industry's business model working exactly as designed. How do they get away with it? Clever marketing, instant cash, no credit check. They make borrowing seem harmless, but it's those least able to afford it, low-income individuals and young people, who are saddled with the highest rates. Lobbying efforts fight against any attempts to cap interest rates. The narrative sold is that debt is just a normal part of life. But there's good news. Once you understand the system, you can begin to break free. It starts with taking control. Step 1. List all your debts. Include every balance, interest rate, and minimum payment. Knowledge is your first weapon. Calculate the total interest you're paying each month. This gives you a clear picture of exactly what your debt is costing you. Prioritize high-interest debt. If your rates are over 15%, focus every extra dollar on paying those down first. Switch to fee-free banks or credit unions like Ally or Chime. They are less likely to trap you in these cycles. Build a small emergency fund. Even a modest amount can help you avoid payday loans when life happens. By taking these steps, you can escape the traps and begin building real wealth. It's worth the effort to take back your future. If you found this helpful, subscribe to our channel and hit that bell icon so you won't miss a single update. Drop your instructions or questions in the comments. We read and reply to everyone. We're in this together. Stay informed, stay sharp. The system only works if you stay in the dark. Now you have the light. I'll see you in the next one. Take care of your future, starting today. Tonight's story is not breaking news. It's breaking reality. In 2026, banks are hitting you with gotcha fees at your most vulnerable moments. With the CFPB's overdraft fee caps lifted in 2025, the floodgates opened. Overdraft and non-sufficient funds fees have surged to predatory levels. The largest banks reported nearly $3 billion in overdraft revenue in early 2026 alone. This is money extracted from those struggling most. Imagine you have $20, a $5 coffee and a $3 tip hits your account, triggering a $35 fee for that tiny $8 transaction. Then a $50 Netflix charge and a $30 gas purchase follow. Each one triggers another $35 fee. In hours, you've lost $105. Average fees hit $35, then maintenance fees, out-of-network ATM charges, and wire transfer costs up to $50 further drain your account. This is a hidden tax on the poor. These fees are carefully designed to target those living paycheck to paycheck with surgical precision. Fintech apps and buy now, pay later services aren't blameless. They advertise as interest-free but hide late fees that roll into high-interest debt. The human cost is millions of families losing $500 a year, money meant for food or rent. It's a vicious cycle of stress and debt. How do they get away with it? fine print buried in 50-page contracts, and a system that encourages overspending just to punish it later. After regulatory rollbacks in 2025, banks have been given more leeway to push these fees into the mainstream, normalizing exploitation. Switch to fee-free banks or credit unions. Look for names like Ally, Chime, SoFi, or Capital One that don't rely on your mistakes for profit. Opt out of overdraft protection. Set up low balance alerts to notify you the moment your account hits a danger zone like $50. Audit your statements monthly, search for the word fee, and dispute them. Banks are often willing to waive them if you simply ask. Build an emergency buffer. Even $500 can be a lifesaver, preventing a small mistake from spiraling into hundreds of dollars in penalties. This isn't bad luck, it's a carefully crafted profit system. By making small adjustments, you can break free and secure your future. Don't let them profit from your mistakes. Subscribe to our channel and hit that bell icon so you won't miss a single update. Drop your questions in the comments. We reply to everyone. Stay informed, stay sharp. I'll see you in the next one. Tonight's story is not breaking news, it's breaking reality. Private equity firms have mastered a strategy for maximizing profits at the expense of everyone else. They raise vast sums from wealthy investors and pension funds to acquire companies with stable cash flows. But what follows is systematic destruction. The first move is the leveraged buyout. The PE firm loads the company with massive debt, but crucially, that debt isn't on the firm's books, it's on the company's. Saddled with this debt, the company is forced to generate extreme cash just to survive, creating a pressure cooker that eventually explodes. Then come the fees. Management, monitoring, and transaction fees, hundreds of millions sucked directly out of the business and into the PE firm's pockets. To pay these costs, companies are forced into special dividends, effectively pulling the remaining lifeblood out of the business to pay back investors. Cost-cutting follows: layoffs, reduced benefits, and deferred maintenance. For the customers, it means higher prices and lower quality. After 3 to 7 years, the PE firm exits. If the company survives, they profit. If it fails, bankruptcy follows, and they still walk away wealthy. By 2026, the damage is undeniable. Reports show that 70% of large corporate bankruptcies are now tied to companies owned by PE firms. Retail was the first victim. Iconic names like Toys R Us and Sears were loaded with billions in debt before being left to rot. 33,000 jobs gone in an instant. Now they've moved into healthcare. Nursing homes owned by PE firms show higher mortality rates. Real human lives are being traded for profit margins. Pensions and retiree benefits, promised after decades of service, are slashed in bankruptcy restructurings, leaving workers without a safety net. Why is this legal? Tax loopholes like carried interest allow these firms to pay lower rates than the average worker. It's a rigged game. Weak antitrust enforcement and bankruptcy laws that favor creditors over workers allow this pillaging to continue unchecked. When these firms move in, communities unravel. Local businesses struggle, property values plummet, and schools lose funding. It's social decay. Innovation is stifled. Instead of long-term R&D, companies are fixated on short-term cash extraction, leading to total stagnation. But you can fight back. Support local, non-PE-owned businesses. Document layoffs and labor violations. Knowledge is your first line of defense. Push for political reform. Advocate for closing carried interest loopholes and protecting pensions. Voting is how we change the system. This isn't creative destruction. It's exploitation dressed up as finance. PE firms profit from looting, while society bears the consequences. We must take action now. If you want the truth behind the headlines, subscribe to our channel and hit that bell icon so you won't miss a single update. Drop your instructions or questions in the comments. We read and reply to everyone. Stay informed, stay sharp. I'll see you in the next one. Tonight's story is not breaking news, it's breaking reality. In 2026, financialization has reached a point where the financial sector no longer serves the real economy. Instead, it has grown larger and more powerful, forcing the real economy to serve its interests. In the past, finance supported businesses and facilitated growth. Now it's about prioritizing gains over development. The numbers are glaring. In 2026, the financial industry captures over 40% of all U.S. corporate profits. Meanwhile, real business investment has plummeted from over 5% of GDP to less than 3%. Corporate debt has hit record highs, but that money isn't building factories or funding research. It's being funneled into stock buybacks and dividends to fuel a speculative bubble, not real earnings growth. Companies are obsessed with short-term profits, sacrificing long-term value for quarterly stock prices. This leads to stagnant wages, while the CEO to worker pay ratio has surged to a staggering 300 to 1. Essential needs like housing and healthcare have become speculative assets for Wall Street investors. Rent prices soar, medical debt explodes, and student loans become lifelong burdens for many Americans. The rise of shadow banking adds hidden leverage and risk. These institutions operate without the same regulations. When they fail, taxpayers are often left to bail out the system, risking another 2008-style crash. Trillions are poured into speculative AI stocks, creating hype bubbles that drive prices up without productivity. Meanwhile, actual innovation remains sluggish, and real-world applications of new technology stagnate. The middle class is being crushed, with fewer opportunities to build wealth or climb the economic ladder. The wealthiest 1% have captured almost all income growth, while the majority see their wages decline. Entire towns lose their employers as companies are sold off for profit. Communities are being hollowed out. As finance drains value from the real economy, Main Street pays the price in jobs and deteriorating communities. This isn't free market capitalism. It's a rigged system, rewritten through tax loopholes and lobbying. Regular people on Main Street pay the price, losing jobs, falling into debt, and watching their communities die. But you don't have to be passive. You can fight back by taking control of your own finances. Whenever possible, invest in real assets, things with tangible value like local businesses or real estate. Stick to low-fee index funds and avoid getting caught up in the hype of speculative stocks or bubbles. Advocate for policies that tax financial transactions and strengthen antitrust laws to protect workers. Minimize your debt and build personal buffers. The less dependent you are on the system, the safer you are. Meaningful reform is the only way to stop this cycle. Until then, stay informed and stay sharp. Subscribe to our channel and hit that bell icon so you won't miss a single update. Drop your questions in the comments. We reply to everyone. Stay informed, stay sharp. I'll see you in the next one.